No. Bond fit. When companies need money, how they raise money? What are the sources they can raise money? Bonds, then issuing bonds, then issuing shares, right? Or revenue generation, correct. So, okay, what are the benefits and merits and demerits of each of its fundraising activities? Let's discuss. What is the benefit of taking a loan? Is there any benefit or
You get your money immediately,
get the money immediately? Okay.
but there will be an interest higher.
A high interest rate. There is procedures also. Whatever you do, there is procedures. Then next, so there is the loan part, right? The risk is, what if you couldn't meet the interest? It's a legal liability comes. They will go to the court. You might sometimes you will be declared as bankrupt. So that's one risk when you take a bank loan. Second one, the easiest option is going to a bank. If you can't do that, you can go for bond issue. Like you issue bond, you take from people. So it is better if you go to bank and take 1 million dirhams loan and you don't pay, they will go to the court. But you take 1 million from 1,000 people, if you don't pay, they don't go, right? They are not they don't have a union, correct? So that's one thing. Second thing, the interest is a liability still there. If you can't fulfill that, there is problem, and you have to work very hard to earn that much interest. You have to pay that interest. So that is the second part. And if you don't want to take this risk of interest, what you can do? You can issue shares. So when you issue shares, what is the problem? For example, you guys are thick friends, right? For last many years. Now you started a business, you are running it. Now you need some fund. Okay, you are desperately want some money in your business to expand. You are not interested in bank loan because you are not sure about your revenue, no reports you can't do. So you are planning to issue some shares, and you doesn't like me, but I am the only man who has money, for example. So you have to compromise the ownership with someone else. Even if you like also, you don't like to share your partnership, right? So that's the one risk. Your hard-earned money, someone is going to take it. You build up this much business. Now he is going to take 33% share if it's an equal share. So the ownership is on question mark. Okay. Sometimes I can make friends with her and put you outside. More than 55% shares or 50% shares I can take. So there's things all happen. So everything have its own cost. So now the easier way is to find money is bank loan. If you can't do that, you go for bonds. Now, when you take a bond, what the company does is you take some money today and you repay them in future days. I think we calculated this question, right? One of the class? No. Present value, time value of money, we discussed? Okay, now it will be easy for you. Okay, so nature of bond. Bond is a formal contract to pay an amount of money that is called the face amount. For example, the bond value is $1,000. That is a face amount. Sometimes it may be sold in premium or something in discount. Like sometimes my bond value is 1,000, but still because my company is a good company and I'm offering very high interest rate, so there is a lot of people to purchase. So I will increase my demand. When there's demand, the price will increase. So I might sell it $1,200 or $1,500. Okay, that's one thing. Just a second. Okay. I might increase the price and sell it when there is a demand. So this happens when your interest rate is more than the market interest rate, right? You know that? Okay. And you sell in discount when your bonds doesn't have any like demand. You sell in discount. Now, here next. Okay. So a bond is a formal contract to pay an amount of money, face amount at the maturity date plus interest at the stated rate at specific interest intervals. Okay. So even though you take, for example, I'm selling on premium 1,200, but I'm selling the bond value is only 1,000. If it's a 10-year bond, after 10 years when you come, I will not give you 1,200. I will give you only 1,000. So that's the one thing. Okay. Face value is the amount which I'm going to pay you. Got it. Now, here, example, at the beginning of the year, a company issues 200 bonds, 8% interest 5-year bonds. That means after 5 years, you will get back your face value. Okay, that is $5,000 bond. Annual cash interest payable payment will be made at the end of each year. Then the total face amount of bonds issued is 1 million. That is 200 bonds into $5,000, 1 million, and the annual interest payable is 80,000. Okay. Next. Now, so by issuing bonds, I'm collecting money and I will pay in future, right? So whatever I'm receiving is in a bulk amount. Like for example, $5,000 bond, I will split this amount and pay you in small installments. The proceeds are received from the investor in the day the bonds are sold equals the present value of the sum of the future cash flows expected to be received from the bonds. Clear? These proceeds equals the present value of the face amount plus present value of the annuity of interest payments. Clear? Are you sure we discussed these things?
Yeah, we calculated the premium and discount bonds in the
previous chapter. Okay. I was thinking why this came again.
Yeah, we discussed
Okay. Now, the bonds are recognized in the financial statement as the amount of proceeds paid for them. That is the face amount of the bond plus any premium or minus any discount. They are recorded as the debt in the issuer's financial statement and as an investment in the investor's financial statement. Clear? Then some theoreticians have argued that bonds should be reported on the balance sheet at the fair value, which is the amount they would sell for in the open market, but we don't follow this. Okay. Then next one. Okay, bond issuance. The cash proceeds from the sale of bond can be equal to or less than or greater than the face amount of the bonds, depending upon the relationship of the bonds stated interest rate with the market interest rate. Okay, on the date of the bonds are sold. Clear? This I will tell you. Like for example, if you take $1,000 and deposit or 1 million dirhams and you deposit in a bank, the bank is offering you 6% interest. Okay, as an investor, you are an investor, and I come up with my bond because I also need money for my business. So I am offering you an interest of 8%. Bank is offering 6%, and I am offering 8%. Where you will invest your 1 million dirhams?
I want to have a safe income
Okay.
with bank,
Okay.
but I'm looking for more interest
More interest
with you.
with me, right?
Yeah.
The same way. So when you come to me, you will not get my bond for 1 million. You have to pay more. Why? Because I am paying. Because there is a lot of other people who is interested in my bonds. Okay. So I will sell it in a premium. Okay. This happens only because of the interest rate of the bond and interest rate of the market. Then, if the stated rate is equal to the market rate, because bank is offering 6%, I am also offering 6%.
Yes, like with the premium amount,
Okay.
So we are giving more money to them.
Yeah, you are giving more money to me.
We can invest that same amount in bank
I'm
also.
taking more interest.
But no, I will tell you that you are talking about effective interest rate. That I will come there. Okay. Now here, for example, bank is offering 6%, and I am also offering 6%. Where do you invest? Bank. Or sometimes, if even if you invest in my company, I can't ask you more money, right? Because I am offering the same amount. So
the interest I'm gonna get for that action amount only, right?
yeah, for example, if the market rate is 6% and I am offering 6%, then you will not pay more than face amount. Got it? You will offer the same amount only. You will pay the same amount only. Got it? Next one. Next scenario, if the stated rate is greater than the market rate, what happens? That is what the premium. I am offering more interest, bank is offering less. You will come to me, I will charge you more amount. Okay. Your question, we will address it. Don't worry. Next one. If the stated rate is lower than the market rate, the company will issue on discount. Now, next question. How much premium I should charge? Or how much discount I should offer?
We calculated last time.
But we calculate it. Okay.
Yeah, we have calculated on tax issues.
Last class. Oh, okay, okay. Okay, fine. You were not there, right? Okay. Now, so this is how we calculate. Like we take the present values of the all future cash flows. Okay. Uh, I think in the last class we had one question. No.
For the chart, when we describe the bonds.
Okay, okay. Okay, this is all thing we discussed. Right. But now, so if the bond value is 1 million and interest we are paying every year is 80,000. So you're having a continuous interest. So we can take the present value annuity factor. Okay. I will take it. Don't worry. When you go through that chapter, you'll see that. Okay, now. So in your backside of your text, you have four tables. That is present value table, annuity present value table, then future value and future value annuity is there. So the present value means here the dollar value after 5 years. $1 is only $0.747 after 5 years, but because the money value is decreasing. So after 5 years, when you get your 1 million back, that value of today is only 747,000. Got it? In other sense, you can say if you want 1 million after 5 years, what you have to do is for 6% interest, deposit 747,000 in a bank. Got it? You will get 1 million after 5 years. You can say in that way. Now, for the annuity cash flow, you are going to get 80,000 first year, second year, third year, fourth year, fifth year. Altogether, you will get the present value is 336,000. So total, your bond issue value will be 1,083,000. So 83,000 is the premium amount you are collecting from the investors. Got it? If it is a discount, okay, this you can do it as a homework. Next. Now, we collected premium or we collected discount. What happens is this amount, this amount is going to be shown in the balance sheet, right? So once you pay your interest, this premium should go to zero. I mean, for 5 years, this 83,000 should go. Balance, there should be only 1 million, which you pay at the end of fifth year. So that how we are going to amortize that amount. Okay. Here we use effective interest rate. Okay. Bond premium or discount must be amortized over the life of the bonds using the effective interest rate method. The market rate of the on the date the bond was sold. Okay, so the same interest rate which you took for present value, same interest rate you should take here also. Got it? Now, how you calculate is annual interest expense you are calculating is carrying amount of the bond multiplied by the effective interest rate. Okay, now see, you're going to pay 80,000 in the last example as your interest, but it is not your interest expense. Interest expense will be how much here? 65,000. Got it? I'll tell you.
So we multiply the word amount with the effective interest.
Effective interest rate. Effective interest rate means the market interest rate. Got it? No. This is your question. Actually, bank is offering 5%, 6%, and I am offering 8%. Right? That was the question. Now, if you invest in a bank, the same amount, what you're going to get is only 65,000. Correct? Because bank is you, as I said, the premium.
Because in that, I will just pay 1 million.
No, he was asking, okay, why should I pay you 1,083,000 to me rather than I would put that money in a bank? Okay, right. That was your question, right? So when you put there, you will get only 65,000 still. Got it? Even though you pay a premium, you are getting only 65,000. But I'm offering you 80,000 for this amount. No. Yeah. Next. The annual interest expense consists of the cash interest paid plus the effect of amortization of a premium or discount. So whatever the discount or premium amount, we have to write it off to raise the face value of the bond. Okay, this question when you do, you will understand. Yeah. See, you calculated the bond value as 1,083,000. Okay, this is going to be shown. Okay, rather than I'll put it in Excel, so you will understand better. You have it out.
No.
So, for example, okay, then I will start from first side, like how to calculate. Then we will go back to the accounting side, like 1, 2, 3, 4, 5. Okay, so okay, fine for you also.
Yeah.
Okay, 1 million is what you invest. So for this, you are going to get an interest. Okay, market interest rate is 6%, right? Market is 6. Interest is 8%. 8, right? 8.
It shows you 1610.
This example.
Yeah.
Ah, no. That's one question is part of premium, and the below part is for the discount. Okay. Now, because why I said 8% blindly, because 80,000 is the interest I'm paying. The face amount is 1 million.
That's
8% because in the first question, 4.13 example. Can you check 4.13 or 4.11 here? Look here.
okay.
Got it. So this 80,000 shows here. Now, so what happens here is every dollar, okay, $1 divided by 1. Market rate is 6%. Okay. So $1 is 0.94. Okay, so each year it depreciates, decreases. So 80,000, what you are going to get every year, the interest rate, your interest amount you are going to get is 80,000, right?
Yeah.
So that is equivalent to $1. And in addition to that, what happens in the 5th year, you will get 1 million back. So your own. So this is the bond value calculator. Clear? Okay, now, so 1,084,000 is what you have in your balance sheet as your bond value, right? Bonds. Now, in year one, what you have to do is, this is what you have in your books. So you have to show something in your P&L, right? Correct. Your expense is your interest. How much it should be? That is 8 million into your market interest rate, not your bond interest rate, market interest rate. Now 65,000 is the interest you're paying, market interest rate, and your interest paid, or you can say cash outflow, 80,000, correct? So the difference, what you get here, okay, is 14,000. This is the interest or premium amortization amount. 84,000 you got as premium, right? This is going to be amortized like this. So yeah, in first year. So this minus interest amortization, yeah. Yeah, in this second year, what happens here? Okay. Um,
It goes on the.
Huh?
It goes on, like, and it's like you need to get the money.
Yeah, your balance in your balance sheet will be 1 million. That you will pay to your investor. Your bond payable amount will become 0. This should be the calculation. Got it? Now we will make it a little bit change. Okay, here market interest rate is this now calculated. Let me put as formula. Okay. Now, what if the market interest rate is 10%? Bond interest rate is 8%. What will be scenario?
Discount.
Discount. So the amount will be 924,000. Got it? And 924,000 will be your balance sheet amount, and your interest will be 92,000, and you are paying 84,000. So there is an excess. There is amortization of the discount amount. So this amount will add to your bond value. Got it? 924 will become 936. So at the end of the 5th year, you have to pay the principal portion 1 million. Got it? So I have discussed discount also and premium also. Got it? And what if you're offering 10%? 8% is what bond offers, and 8% is what market rate also. Then what your
No premium or discount.
no premium or discount. Whatever you collect, you pay it back. Halas. So the maturity date, the discount or premium is fully amortized, and the carrying amount of the bond equals the face amount. Now there are different types of bonds we have. We will discuss that. Look, don't expect someone will say you, okay, this is a term bond or this is a serial bond. From the nature of the bond, you should understand whether it is a term bond or a serial bond. Okay. Now, come forward on the basis of maturity pattern. So whatever we discussed in our example was a term bond. Okay, every term they pay you an interest. At the end of the term, they will pay you a principal portion. That is a term bond. There is also serial bond, which comes with principal portion plus interest. They might pay some amount. That is kind of EMI in the bank. In banks, you know, right? There is EMI. Okay, that's when you take loans, they ask you to pay a certain amount. That amount is principal plus interest portion. We call it as EMI. Okay, EC monthly installments, right? Okay. Now, so the same way in bonds also, the amount will be interest plus principal portion. Now, term bonds have a single maturity date at the end of its term. The examples in this study unit pertains to regular term bond. So whenever you get in an examination question, it will be basically on term bond only. Otherwise, they will mention serial bond. Now, serial bond matures in stated amounts at regular intervals. Investors can choose the maturity that suits their financial needs. Clear? Next comes repayment provisions. On the basis of the repayment provisions, it can be income bond or revenue bonds. Income bonds are interest contingent to the issuing firm's profitability. So as we said, normally we have a problem with the bond is that whether we have profit or not, we have to pay the interest, right? So there is some option. When I issue a bond, we call the bond agreement as debt covenant, okay, or bond covenant we say. In that we will mention, okay, I'm issuing a bond, face value is this, interest is this, but one condition I have wrote, if I have profit, then there is interest. Otherwise, no. If this particular clause is there in your bond, then it is an income bond. Got it? Second one is the revenue bonds are issued by governments and are payable from specific revenue sources. Like there is kind of railway bonds. In India, we have railway bonds. For example, metro bond. If there is, I don't know whether it is there or not. There is, we have national bonds, right? In UAE. Same way, in national bonds, what they do is on the basis of national development, on infrastructure development, the revenue they generate, they pay as interest to you. The same way, if there is a metro bond, When the metro makes money, whatever payment you are going to receive is from the metro's money. Okay. Now, next comes secularization, that is securitization, that is based on the security. Mortgage bonds. For example, if I'm issuing a bond of my company and I say it is a mortgage bond, in that there will be some underlying asset. Maybe I issue bonds on the basis of my property. If I don't pay you back the money, you can take my property. Just like you take a bank loan with any property, not like personal loans. In mortgage are backed by specific assets, usually real estate. Then comes the debentures, which are not secured by specific collateral. Instead, they are secured by the full faith and credit of the issuing firm. That is debentures. You don't have any guarantee they will pay or not. Next, guarantee bonds are guaranteed by a third party, that is the parent of the subsidiary that issues the bonds. Got it? Next, collateral trust bonds are secured by financial assets such as stocks or other bonds. Then, equipment trust bonds are secured by a mortgage on movable equipment such as aeroplanes and railroad cars. Okay. Next comes on the list of valuation. We have variable rate bonds. That means, as we discuss here, all year the interest rate is same, right? For example, there is some company I'm offering every year, like nowadays bank says, right? IBOR plus 3%. Okay. Same way I'm saying, okay, for my bonds also IBOR plus 2%. So it's a flexible rate. Got it? Whenever the IBOR changes, your interest rate changes. Pay interest on depend on market conditions. Then comes a zero coupon bond or deep discount bond. Here, when you take this kind of bond, they will not pay you interest. Every year they will not pay you interest. But the yeah, I'll tell you. Okay, if it's $1,000 bond, face value bond, I will offer you it for $600. You pay me $600 today. After 5 years, I will pay you $1,000. So the difference, 400 what you are receiving in bulk is the interest portion. So that's called the deep discount bond or zero coupon bond. Okay, zero coupon bonds bear no stated rate of interest and thus involve no periodic cash payments. The interest component consists entirely of the bond's discount. The discount is amortized annually on a straight line basis, but no periodic interest payments are required. The cash outflow for interest does not occur until the bond itself is retired. Okay. Then comes the commodity-backed bonds are payable at prices relating to commodities such as gold. We have gold bonds, silver bonds, like petroleum bonds, right? Like crude oil bonds are there, okay, in commodities market. Next comes redemption provisions. On the basis of redemption, like for example, I issued some bond. If it's a 10-year bond, I have said the tenor that is 10-year. Interest rate is mentioned, everything I mentioned, and including that one clause I said, if you want money at any time, you can come and redeem it. It's up to you. Or okay, here it can be on the basis of company. I would say, okay, even if it's a 10-year bond, sometimes I will call it back. I will call you back and I will give your money back. Okay, the face amount I will give you back. So see this kind of callable bonds. Is there any problem with that? You invested for 10 years. After 5 years, I call you, come take your money back. Is there any problem in that? Will you be happy on that?
No, because maybe I'm planning to get my money back after 10 years.
Okay.
So, and so,
So if you okay, yeah.
Depends actually, right?
Huh?
Depends actually. If I'm getting that money after 5 years, if I'm getting it, if I can buy a different bond with higher interest, easy to for me.
It's like a recent company will not give you money. That's what. For example, he said the same point. I'm offering you 10% interest for the bond. I issued to you, and I included this particular line inside the bond agreement. That's callable bond. That means I can call it anytime. Okay. Now, after 3 years, interest in
So
the
that means the company
company can call back. So interest in the market fall. Okay. For example, the bank interest was 8%. That's why I was offering you 10%. Now the bank interest is only 4%. Why should I give you 10% interest? I can go to a bank and take 4% interest loan, right? So what I do is I will go to bank, take 4% interest loan, and I will pay you back. I save 6% interest, right? Got it? So such cases, as an investor, you are in trouble because sometimes mostly who are investing in bonds are retiring people who are planning for retirement, because in shares you don't get a regular income. In bonds, what you get is every year you get a certain percentage of interest. Suddenly I come and say, okay, no, I'm finishing your bond agreement. Now, how you will get your pension? This was your pension plan. So it's a riskier for an investor. Okay. Now, callable bonds, also called as redeemable bonds, may be repurchased or redeemed by the issuer at a specified price before maturity. During a period of falling interest rate, the issuer can replace high interest debt with low interest debt. Clear? Next, convertible bonds may be convertible into equity securities of the issuer at the option of the holder under specific conditions. Convertible bonds generally pay a low yield than comparable non-convertible bonds. Convertible bonds means I issue a bond. In issuing bond, what I do is I'm borrowing money from you. But in that, I have mentioned, if you want, you can convert this to shares. Now you will become a shareholder. Okay, that's convertible bonds. There. Next, whatever we discuss in the bonds, it's the same principle here. The calculation is same here for the non-current notes payable. You know what is notes payable, right? Like you borrowed something from someone. If you can't pay within 30 days, you will give him a check or a promissory note. That's called the notes payable. Then the validity of the notes payable is the validity of that debt. Now, if it's a long term, for example, I purchase something from you, and now my outstanding is 1 million, 100,000 dirhams, but I don't have immediate cash to pay you. So I sit with you, I had a negotiation, and you said, okay, I think do one thing, pay us in next 3 years, no problem. You do business with us, no problem, because you have a good track record. So you gave me 3 years. Now, what you're going to get is this 100,000 is divided into 3 years, and you're going to get. Here you are going to lose some money as interest. Correct. Now, so that's what we are going to calculate here. Some notes require one principal payment at the end of the notes term plus periodic interest payment during the notes term. Clear? Now, an entity agrees to give in return for merchandise a 3-year 1 million note bearing 8% interest paid annually. The effective interest rate is 6%. That means the market interest rate is 6%. I'm offering you 8%. So now what you have to do is you have to discount this 1 million for 3 years. That is 100,000 for 3 years with 6%. Clear? And the interest I'm going to give you is 8,000, right? So 8,000 interest into present value annuity of 6% for 3 years. Then and 1 million, 100,000 you are going to pay after 3 years. So 83,000. So total 105 is your present value of the notes. So this is what the notes payable or the inventory's value, what you sold to me, will be 105,000. Clear? Then your entry will be inventory account debted to premium on notes payable account debted to notes payable. Clear? Because after 3 years, he will pay only 1 million. Got it? Next, other notes require equal periodic principal payments plus interest. This is other option. Okay. Each periodic payment includes an equal amount of return of principal and an amount of interest accrued in the beginning carrying amount. See here, the examples. 120 is what you borrow, 10% is not payable. To interest you have to pay to the bank. Okay. And you have to pay in 3 equal installments. That's 40,000 is what you're going to pay for the principal portion. So 120 you're going to pay in 4 installments, but you have to pay an interest of 10%. So 120,000 into 10%, that is 12,000 is the interest expense, and 40,000 is the principal portion. So how much cash outflow you will have? 52,000. Got it? And next year your balance is 80,000. So interest expense is 8,000. So 48,000 is what your cash outflows. So at the end of third year, your carrying amount will become 0. And next one is how you take a bank loan, EMI, equal periodic installments. Okay. Here you take 120,000 as loan. Okay. And 10% is the interest. And your EMI, or what we say the equal periodic payments, is 48,254. That means this includes your interest portion also. So 120 into 10%, that is 12,000 is the interest. Okay. So 48,000 is what you pay. So 48 minus 12,000, 36,000 is the principal portion. Got it? You minus, you will get 83 as the carrying amount for the first year. And second year, 83 into 10%, that is 8,300. So what you can see is diminishing interest rate, you could say. When you take a bank loan, also same way. First year, the principal portion, whatever the EMI, the majority of your portion will be like the interest portion in your loan amount will decrease year by year, and the principal portion amount increases. So that's why people used to say when you take a bank loan, in the initial years you pay the higher interest. Okay. Then, yeah, that's it for this chapter. Any queries, Ubaid? All good? Now unit number 5, small 2 minutes break. Now, here we discussed almost all parts. Now we reach revenue recognition. So it's one of the very important area, even in CMA as well as for your career also. When to recognize revenue, how to recognize revenue. Those things we will discuss here. Okay. Then we will discuss impairment of and disposal of long-lived assets. Revenue from contracts with customers. Now, we all have customers, right? Without any customer, there is no business. So, how do you recognize your revenue? What is the criteria in recognizing revenue? Sometimes, for example, I'm selling some goods to people. Okay, I sell something, I invoice it. Okay, in this case, also I can't recognize revenue. There is few conditions. There is sometimes there is FOB shipment, FOB destination. There is shipping terms. Then once the goods receive the customer only, he will accept it. Okay. In between, if we lost the goods, it is on our cost. We can't recognize things. Sometimes there is FOB seller's port. Then I forgot the name. FOB destination and FOB one more thing was there. Okay, for example, if the goods left my warehouse, then I will record a sales. It is the customer's responsibility to take. So this is one condition we discuss. And sometimes there is other things. This is very pretty easy when you sell something. What if for services? As you work in college, he joined a college for a course. The course fees is 30,000, and it's 1 year course. He pay you 30,000 instantly, and you have 2 semesters. How you are going to recognize it? Will you recognize this 30,000 as your revenue?
No, after delivering the service.
After delivering the service. There will be have some terms like you have to pay your first semester fees before this date. That means that particular date is the date which you recognize your revenue. So it is a 6 months semester, then you will recognize only half of his revenue in the first semester, half will be shown as the advance. Okay, so that will be refundable if he is not continuing after first semester. You will have some terms and conditions for that also that to cancel classes. So the same way here, we have 5 steps in recognizing revenue.
So that's why.
So the core principle is that an entity recognizes revenue from the transfer of promised goods or services to customer in an amount that reflects the consideration of which to which the entity expect to be entitled in the exchange. Sometimes, okay, can we do like this? I have some tomatoes and you have some apples. Can we sell it to each other? Tomatoes and apples?
No, what is the
Huh? Can we do it?
even exchange or
Yeah, exchange. I can sell you tomato and you can sell me apples. And then how you will account in your books? Debit tomato, credit. How you will do that? For that, at least one of the items value you should know. Okay, for example, you don't know the value of apple, but you know the value of tomato. For 10 tomato, it is 100 grams. And you don't know what is the value of 5 apples. You are exchanging five apples. If you are giving me 5 apples and taking 10 tomatoes, that means that 5 apples value is 100 grams. So either it should be clearly stated any of these two items rate, okay, or fair value, you will take it. Now, the first 5 steps is that identify the contract with the customer. First, he comes to you as a student. First, you should understand which course he is joining. How many semesters are there? What is the fees? And what are the conditions? Like, what is the terms of paying the fees and all? The first thing. Then identify the performance obligation in the contract. That's what you said. When you provide the service, you will understand. Sometimes what happens, you have AMCs, you pay monthly. Okay, even if they don't come to your office, still you have to pay them because their performance obligation is there. Okay, they are ready. Whenever you call, they will come. For that, you are paying that. Next is the determining the transaction price. Then you need to decide what is the transaction price, at what price we are going to provide service to you. Okay, that why we have to determine, because in some cases it's not easy as you think when you take for commodities. When it comes to service side, it is more complicated. Sometimes you might give offer like cleaning service, for example. There can be two conditions. One is labor plus cleaning stuff, or only labor. In such cases, what is in the combination, how we will decide what is the price for labor and what is the price for commodities. Next comes the allocation. Allocate the transaction price to the performance obligation of the contract. How to allocate it? For example, if there is goods and service, how to allocate goods value, service value, and sometimes if it is done continuously, a service providing goods continuously throughout the year, then how you are going to allocate it. Next one is a recognize revenue when a performance obligation is satisfied. As I said, his fees you collected 30,000 for 1 year, like semester wise. Then in the first semester, you will recognize half of his payment, 15,000 as your revenue, balance 15,000 after completing the second semester. Now, in identifying the contract, what all stuff you will look into. That is, a contract is an agreement between two or more parties that creates enforceable laws and obligations. Okay, you can force the other one to do once you have agreed to anything. Okay. Like for example, I agree to you to take some goods from you for 100,000 dirhams. Once I take the goods, you can force me to pay. Got it. Next one, revenue is recognized for a contract with the customer if all of the following criteria are met. The contract was approved by the parties. Okay. The contract has commercial substance. Then each party's right regarding goods or service to be transferred and the payment terms can be identified. Then it is probable that the entity will collect substantially all of its the consideration to which it is entitled according to the contract. Now, we will divide this definition here. Contract was approved by two parties. Okay. Can we recognize any revenue in a marriage? In a marriage? No. According to this definition, we can do, right? Contract is approved by two parties. Both of
There's no revenue in marriage.
yeah, in India we have, right? We have dowry. No, you girls have, right? There is like, what does we say here? Meher.
Yeah.
Yeah, that's revenue for you guys. Right?
It's not money, like, it's like gold or something.
Yeah, gold has a value, right?
Yeah, but it's not a revenue. It's not like, this is a. It's not the revenue for the girl.
Okay, it's not a regular one, right? Okay, so that's why all contracts are not revenue generating contracts. So there should be commercial substance. If you made marriage as your commercial business, then you can definitely recognize. Then the other one is each party's rights regarding goods or service to be transferred and the payment terms can be identified. It should be clearly mentioned what is your right, what is my right, what is my responsibilities, what is the goods we are entering into contract. We can't say, okay, I will sell you something. You should pay me something. You can say something like that. Okay, you should clearly say how much money you are going to pay for what goods and all. Next, it is probable that the entity will collect substantially all of the consideration to which it is entitled according to the contract. For example, we entered into a contract to sell some product. Okay, I delivered you the goods. After delivery, I'm in a doubt. Oh, I can't collect money from her because she ran away. Okay, she is not here. She went to some other country. In this case, I can't recognize that. Got it. So that's why we say that it is probable. Probable means in future event it's likely to occur. If you can collectively, you will recognize the revenue. Otherwise, what is the problem? If you can't collect and you recognize revenue, what happens?
There's no cash income to revenue.
Okay. Then else what else? Again, huh? It will become bad at eventually. But in recognizing it, what is the problem? I will tell you one example. In one of my organization, I was working in a hospital. We had a contract with someone else. So we had a contract for example, for blood test. It's 100 dirhams. Okay, for test. But according to the contract. But we are recognizing because there is a glitch in the software. Whenever this particular contract people come, the invoicing is going for 250 dirhams. I know 150 I can't collect. So what happens is 250 is recorded in my books as sales. For this 250, I have to pay VAT. One risk. Second thing, there is corporate tax. In coming years, there will be corporate tax. For this $150, which I am not going to collect, and the other party will never pay me, I have to pay corporate tax also, 8%. So these things will arise. So that's why if it is collectible only, we will recognize. Clear? No. If the critical description described above are not the criteria described above are not met, if the, for example, if the collectability cannot be reliably estimated, the consideration received is recognized as a liability and no revenue is recognized until the criteria are met. Okay, for example, we entered into a contract. Okay, I entered into a contract with you to deliver a ship. The value of ship is 100,000. He paid me 10,000 as advance. Okay, now I can't recognize this as revenue. Whatever I received, I will record this as just an advance. Got it. Now, next, however, even when the criteria described above are not met, revenue is the amount of non-refundable consideration received from the customer is recognized if at least one of the following has occurred. Like sometimes you might see if there is an advance paid, non-refundable advance. You might have seen this, right? When you go for booking a car, there is a non-refundable advance like 1,500 or 2,000 dirhams. So this, how the company is going to recognize this 2,000 dirhams is what we are going to discuss. If this is a refundable, then they can't recognize this as revenue. This is a liability for them. Whenever I come back, they have to pay me back. Clear? Otherwise, these are the conditions that the contract has been terminated. If the contract is terminated, don't give the money back. Okay. Next, you have to recognize it as revenue. Then control over the goods or services was transferred to the customer, and the entity has stopped transferring additional goods or services to the customer. Yeah. Series of payment, like you paid 10,000 dirhams in advance. You said, okay, every day, or I would say 1,000 dirham is for your mess, food expense. I'm a restaurant. You paid me 1,000 dirham. You paid me 500 dirham. Monthly payment is 1,000. After selling, said 15 days food to him, he didn't pay me the balance amount. Okay, 500 I have sold to him. 500 I will receive. But the contract is for 1 month. But he didn't pay the balance amount. So now what I will do, I will stop selling goods to you and recognize this 500 what I received as advance as my revenue. Got it? So that's what control over the goods or services was transferred to the customer, and the entity has stopped transferring additional goods or services to the customer. The entity has no obligation to transfer goods or services and has received substantially all consideration from the customer. Clear? A contract modification exists when the parties approve a change in the scope or price of a contract. Then it is accounted for a separate contract if the following conditions are met. The scope of the contract increases because of the addition of promise to goods and services that are distinct, and the price of the contract increased uh, by a consideration amount that reflects the entity's standalone selling price of the additional promised goods or services. Like we have a contract with each other, like okay, I will keep the restaurant example. 1,000 dirhams for 30 days food. Okay, this is what he said. Now he said, okay, I want non-veg also. I will change the contract. That's actually modification. Now, what he say after 2 days, he is saying, okay, I have one more friend in my room. You send more food, and he needs some biryani kind of stuff. Now it's an additional separate contract. That's what we are saying. What is a separate contract, and what is a modification? Clear. Next comes identifying the performance obligation in the contract. How to identify the performance obligation? Okay, and how to identify whether it is completed or not. Now, a performance obligation is a promise in a contract that with a customer to transfer to the customer goods or service that is distinct, or a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. Clear? Yeah. The promised goods or services are distinct if the customer can benefit from them either on their own or together with the other resources that are readily available. And the entity promised to transfer them to the customers separately, identifiable from their promised in the contract, that is distinct with the context of the contract, is separately identifiable goods or service, that does not significantly modify or customize another goods or service promised in the contract. It is not highly dependent on or highly interrelated with other goods or services promised in the contract. Anything? You understood or not? All good? Okay. A contract may include a customer option to acquire additional goods or services for free or at a discount. Okay. You might get this from Lulu and all those, right? You purchase for 100 dirham, they will give you one unwanted coupon, which is you will never use for a camera or for a television. So, if the option provides a material right to the customer, the result is a separate performance obligation in the contract. Got it? Now, how to determine the transaction price? Okay. The transaction price is the amount of consideration to which an entity expect to be entitled in the exchange for transferring promised goods or services to a customer. For how much money I'm going to sell this product or give you a service. That's called the transaction price. Okay. It excludes amount collected on behalf of a third party. That is VAT or sales tax. That's why we don't consider VAT. Even though we are collecting, we are not collecting for us. We are collecting on behalf of government. We collect, we pay to the government. And any consideration payable to the customer, such as coupons, credits, or vouchers, reduces the transaction price. Got it? Uh, when you purchase from Zomato, you have 10% discount. So after discount, whatever the amount shows is the sale value. Clear? That's the transaction price. Then to determine the transaction price, an entity should consider the effects of the time value of money and variable considerations. By time value of money means I entered into a contract with you to deliver a house. Okay, you started the contract. I'm constructing a house for you, or I'm a builder, for example. So what I do is uh, now I'm going to collect some money. After 2 years, I'm going to collect some other money. So in this case, the transaction price is determined considering the time value of money. Even though you are paying 200,000 after 2 years, I need to book it now on the transaction price, like what we did the present value for the bonds. The present value we have to take. Clear? Then, and any other variable considerations, like for example, uh, have you ever worked in a mall or seen anything in malls? Like how the shops in a mall work? No idea.
What do you mean how?
In malls, any of the malls, when you take a shop, there may be two kind of rent. What is a fixed rent? Fixed rent, that is, for example, 100,000. Whether you have sales or not, they don't care.
You should pay.
You should pay the 100,000. And the other method is you should pay 30,000 base rate plus 3% of your sales or 5% of your sales. Now, the transaction price means this 30,000 plus the variable consideration. Variable consideration means the sales portion. Got it? Percentage of the sales. Now, the revenue recognized must reflect the price that a customer would have paid for the promised goods or services if the cash payment had been made when they were transferred to the customer. Okay. That is the cash selling price, for example. As I said, okay, if we are exchanging goods, as I said, tomatoes and apples, like tomatoes, whatever price, if there is no apple with you, what would have you pay to me? So that's what the transaction price is. Clear? The thus the transaction price is adjusted with the effect of the time value of money when the contract includes a significant financing component. Okay, like in bonds, do you remember that the questions we did last a second? It's just how much money you show here as inventory? 105,000, right? So what was the goods value? 100,000. So 105,000 you show it as inventory. That means this is what you're going to sell to someone else. You are going to recognize this as revenue. Got it? The same way, yeah. This is the transaction price. Why? In this, there is an interest portion of 5,346. Got it? Wrote here. Like thus the transaction price is adjusted for the effect of the time value of money when the contract includes a significant financing component. Now, the following factors should be considered in assessing whether a contract includes a significant financing component. These things will not be mentioned openly. Like for example, if I'm paying, I'm going to purchase a car from. Usually, some companies give offers, right? Don't take loan. We will provide you loan. Some long back, Kia was you doing that. You don't go to a bank for a loan. They will provide you car 1% or 2% you pay every month. But the car price is little bit higher than the cash price. So that's what the significant financing component. If you give cash and purchase, you would get the car for 100,000. Now you are in this offer or this scheme, you have to pay 110,000. So this 10,000 is the financing part. Okay. Now that's the difference between the cash selling price of the promised goods or services and the amount of consideration to be received. Got it? Then the combined effect of the expected time between the payment and the delivery of promised goods or services and the market interest rate. Got it? Then a transaction price should not be adjusted for the effect of the time value of money if the time between the payments and the delivery of the promised goods or services to the customer is 1 year or less. That's why when you sell something to a customer for 60 days credit, 90 days credit, you don't take interest, right? If you are giving him more than 1 year, you will charge interest. Clear. Then the customer paid in advance and the transfer of goods or services at the discretion of the customer. You paid something to me and you said, okay, I will come back one day and take the goods. For this, I don't need to give you interest because it's your decision. What if I collected money now and I said, okay, I will deliver you after 2 years? Then I have to consider the interest portion. Got it? Now, okay. An example is a bill and hold contract in which the seller provides storage service for goods it sold to the buyer. Then, a substantial amount of the consideration promised is variable and its amount or timing varies with future circumstances that are not within the control of the entity or the customer. Okay. Then, an example is consideration in the form of sale-based royalty. Then, interest income or expenses recognized under the effective interest method. It must be presented in the income statement separately from the revenue from contracts with customers. This will not finish right today. Okay, we'll do one thing. Transaction price we will continue with class. Okay. Even I am doing sleepy. In some words I can't even see. Okay, bye. Thank you. We'll meet you next week.